Welcome, everyone. Welcome back to WWTA News. I do thank you all for stopping by one more time to see what's going on this channel. Yes, got some news articles we're going to go through today. Wonderful news out there, and we'll probably have some discussion. I know it's getting harder and harder to keep up with so many different things going on. I know it's so much information out there. But what I'm going to try to do is work harder to get this information in front of you. Okay, so before we get started, if you haven't hit that like button, could I get you to hit that like button? It just helps get this video in front of more people. And if you have any family, friends, or loved ones who you think could use any of this information, please feel free to share the channel or the link to the video. Now, with all that out the way, let's figure out what's going on in the news. So we've got some news here. It says Oxford City Football Club to accept Bitcoin for match day tickets. Oxford City Football Club is accepting Bitcoin for payment. We've also got an article that says Gucci is accepting ApeCoin for payments. So that's two articles where cryptocurrency or digital money is being accepted for payment, which is a wonderful thing. Obviously, we know we're going into that space where this is going to be an everyday thing. So, and let's talk about that for a second, because, we got news and it's things that we should talk about as we're going through the news. What's really going on in the world, right? Obviously. So all these nations, countries, they're separating, right? They're separating from this system that has existed for the longest time, where the United States dollar has ruled all nations. I don't really understand how we got to the point where the United States dollar ruled all the nations. Could be conspiracies there, could be anything. I'm not really going to get into all that. It is what it is. You do your research and see what you come up with, and then put in the comments below. Then we could probably talk about it. But for the longest time, the United States has held domination over other nations and countries. And so everyone had to use the dollar in order to conduct business. Now, we've come to a point in time when everyone's not using the dollar to conduct business. So this is scary waters if you live in the United States and you're not paying attention. But then again, if you're not paying attention, you'll just kind of get caught in the storm when it happens, and then it is what it is. But if you have been paying attention, you do understand that so many things can happen. You're looking at the possibilities, with all the variables included. What are the possibilities of the outcome? So, knowing that most countries, or if not all countries, are trying to get from up under that dollar and the power of the dollar via sanctions, you're going to do what we say, or you're not going to have support of the dollar. The nations are done with that. So when we hear about more businesses, corporations getting involved with the digital asset market, the digital money market, it's like we can see clearly it's not a good look for the United States. Okay, you can see what's happening in Europe. They're having issues with their money already. Nobody wants to deal with these particular things. All right. So seeing these two articles, it just helps us see that, yes, the dollar's fading away. We got an article here that says crypto, a new bill aims to give the CFTC more authority to regulate crypto markets. Goes on to say the bill would set a national regulatory standard for crypto, define which tokens would fall under the digital commodity category, and require all crypto trading platforms to register with the CFTC. Crypto players will be held to the same rules as traditional financial brokers and trading platforms that facilitate trading in commodities and spot markets. The bill amends the definition of a commodity to include digital commodity, which applies to some crypto tokens. Bitcoin and Ether, for example, are included in the definition of commodities, while securities are excluded. This bill also introduces new categories for digital commodity brokers, digital commodity custodians, digital commodity dealers, and requires them to register with the commission. It says, in quote, "We are closing regulatory gaps and requiring that these markets operate under straightforward rules that protect customers and keep our financial system safe," Senator Stabenow said in a statement. All right, so, wow. We need regulation, obviously. It's no shocker. There are commodities and there are securities inside the digital space. So I know a lot of people are saying, well, is that going to hurt anything as far as the digital asset or cryptocurrency space? And technically, no. With rules and regulations, that's going to stop a lot of the criminal activity. Whether you want to believe this or not, there is criminal activity. There's always going to be criminal activity wherever there's a chance for criminal activity to exist. It's yin and yang. It's light and dark. You know what I'm saying? You can't have one without the other. So bringing in this legislation is going to only bring in more corporations. It's going to bring in businesses. It's going to bring in the money that's not here yet. And if you've been in this space for some time, you understand that the money in this space is pretty much just retailers, common people like you and me, and then those who have more money that are in this space trying to find themselves a foothold. So those things exist, but the real money's still not here yet, and it's on the way. So we kind of should be encouraging and be more excited about that particular news article, because that's going to bring everything else right to this space as we need to see it, so that all of the currencies and or commodities and or assets and or securities that you might be holding will grow in value right before your eyes. So yeah, we need it. So we got an article about Michael Saylor. It says he steps down as MicroStrategy CEO. The company takes $917 million charge on Bitcoin. The MicroStrategy announced on Tuesday its founder and CEO Michael Saylor will step down from the top job and take a new post as executive chairman focused on the company's Bitcoin strategy. Now, I know people might be like, oh, they're firing him. Well, I don't know. It seems to me like they're kind of making him liable for that, this whole thing with Bitcoin. Now, let's not play stupid. All these big corporations, they've already looked at the numbers. They look at spreadsheets and they look at numbers. Where common retail people don't look at most of us don't zoom out. And I say most, not all. So if you're a person that zooms out, great job. That's how you're supposed to do things. So, but the most in the retail market, people, they don't zoom out when they look at charts. So companies, corporations, these big time investors, they've been doing this stuff for years. They always zoom out. They want to see the bigger picture. So MicroStrategy, in my opinion, which I'm 100% sure, they're looking at the big picture. And when they look at the big picture, they see the beginning. They see what they've traversed through. And they have already estimated the possibilities to come. All right. So with Michael Saylor coming down from chairman to the Bitcoin, focus on the Bitcoin strategy, it just alerts me that they don't want people paying too much attention to the part where Michael Saylor's hard at work. They want them to feel safe and confident because, your retailers, they look at the small picture. They never back up and look at the big picture. So they're probably causing a separation, not to scare or put in panic the people that look at the small picture. But let's continue the article. It says MicroStrategy reported quarterly results that were light of Wall Street estimates on Tuesday, with revenue coming at $122.1 million. Against the expectations for $126 million. Losses in the quarter totaled $918.2 1.1 million, with 917.8 million attributable to the company's Bitcoin holdings. All right, so Bitcoin lost a great amount of value. It was at 60 plus thousand. Okay, but again, like I said, these companies look at the big picture. They zoom out, so you're not going to slide a fastball through here. They've already seen the beginning. They've seen what was traversed through, and they've already formulated an idea on the outcome. They see the other countries involved in this space and not backing out. So you don't get it twisted for 1 second and think that they're getting rid of this guy and they're not trying to deal with Bitcoin, right? Don't even get that twisted. It's just, this is probably to help people that are looking at the small picture feel safe. It says in a statement, MicroStrategy said Saylor was focused primarily on innovation and long-term meaning they're looking at the big picture. Corporate strategy, the corporation's looking at the bigger picture, while continuing to provide oversight of the company's Bitcoin acquisition strategy. As executive chairman, in this quote, I will be able to focus more on our Bitcoin acquisition strategy and related Bitcoin advocacy initiatives, while Fong will be empowered as CEO to manage overall corporate operations, Saylor said in a statement. The long term means that they're not going nowhere with this. This guy is going to be focused on buying up as much Bitcoin as he can at these low prices, looking at the past prices and how it's moved, the trajectory of Bitcoin in this space, right? So, don't get it twisted. Like, oh my God, they're getting rid of Michael Saylor. He busted. He screwed up. He lost money. Come on, man. Come on, stop that. If you look at where Bitcoin came from, you know what I'm saying? Come on, bro. And who knows what they were paying when they got their initial Bitcoin? You know what I'm saying? If they got Bitcoin at nine stacks, 20, they're in the 20s. If they were buying their Bitcoin at 3 stacks, they're in the 20s. Okay, and again, this is why retailers don't belong in the space with the big boys, the big sharks, because they're in this for the long haul. So if you're not studying what the big boys are doing, then you're not going to understand, and you're going to be hopping out the water every 5 seconds. Oh my God, there's a shark fin! Get out the water! Run! You know what I'm saying? So that's something that you have to, if you're going to be in this space, you have to be aware of. You know what I'm saying? And I'm not a financial advisor. This is not financial advice. This is just being observant from a higher view, so you can understand what's actually happening. And I'll say this: if you're standing in a crowd of people, right? Imagine yourself in a city. Go to New York. Put yourself in New York. Put yourself in Manhattan or something. I've never been there. I'm just trying to imagine. So let's all imagine together. Put yourself at a busy intersection in Manhattan, right? And then all these people are there. How much can you really see if you're standing in that crowd of people, right? There isn't much you can see. Your view is limited. Now, imagine that you're in that same spot, but you're a bird. And as that bird, you're maybe on a building that's 5, 6, 7 stories high, and you're looking down. How much do you think you can see, right? Now, imagine that you're standing on a 20-story building in that same location, right? How much more can you see? Are you getting it? Now, imagine you're in a plane flying over Manhattan. How much can you see, right? Now, imagine that you're a satellite that's moving across these areas. How much can you see? Are you getting the picture? So if you're not thinking that way and you're just operating based on I'm standing in the crowd of people with everybody watching, you're not seeing much, okay? You're not seeing much. But anyways, let's continue. We got another article that says, seller beware. U.S. home buyers are backing out of deals at the highest rate since the start of the pandemic. Here's what that means for real estate. According to a new report from real estate brokerage Redfin, around 60,000 home purchase agreements in the U.S. fell through last month. That equates to 14.9% of all homes that went under contract in June. So, what could have caused that? You've probably heard of some house in your neighborhood getting sold for well over its asking price because of multiple offers. When they are competing offers, people don't want their deals to slip away. But when there's no competition, things can work differently. The slowdown in housing market competition is giving home buyers room to negotiate, which is one reason more of them are backing out of deals, says Taylor Marr, Deputy Chief Economist at Redfin. And I quote, "Buyers are increasingly keeping rather than waiving inspection and appraisal contingencies. That gives them the flexibility to call the deal off if issues arise during the home buying process." Rising mortgage rates are also forcing some buyers to cancel home purchases. If rates were at 5% when you made an offer, but reached 5.8% by the time the deal was set to close, you may no longer be able to afford that home, or you may no longer qualify for a loan, Marr explains. So these are true statements. So when the interest rates change, if you haven't closed out that deal, then the banks are going to come at you and say, look, the interest rates have changed. The amount of money you can borrow has changed, which means you can no longer purchase that home that you had your eyes on, or that you were trying to get that contract or got into a contract with, but the deal hadn't closed out. Right. So because of that, then the bank backs out of the deal. They're no longer going to finance it. And so that puts the homes back on the market. Now, we do see that because there was a situation where everybody was trying to buy a home, right? You got people coming out of rich areas because they understood now they can work from home, and they didn't want to pay these outrageous prices, so they started moving south. They were migrating, right? And I'm talking about the East Coast. They were migrating from the north to the south, and so things were changing. But with the financial issues, that's not a great thing. So now these people that were trying to get these homes, the amount of loan value that they have has altered, so they can't just buy those homes. So then they got to then look for different homes, which might change the decisions they're going to make in the future, because now they might be in a position where they can't get that home they really want, and they got to take something lesser than, which is not going to be adequate. Right. So it's like, I might as well just go stay where I'm at and just, it is what it is. And that's, in my opinion, one of the major things that's been going on. And so we still have a problem, though, with the interest rate going up. It's lessening the amount of value for these homes. So there's only one thing left to happen, and it's going to happen over time. The sellers of homes are not going to get what they're asking. That's going to change. We're going to see homes that used to be 110, 115 that were jumped up to 300K. We're going to see those homes drop back down. It's coming. Just be patient. Homes that we saw at 250 that jumped all the way up to 400 or 500, we're going to see those homes drop back down, because with no buyers, the market changes. Now you got to do what you got to do to get that property off you, lest you stay there and pay the taxes. And then with you having to pay that loan, you're going to try to take in tenants. And if the tenants can't afford the outrageous price you have to charge to pay back that loan, you're not going to have tenants. And most people don't want to get involved with tenants because, with what happened during the pandemic, tenants were unable to be evicted from a home. So landlords don't want to get involved in that mess either. So that causes a situation in which we're going to see an outcome in the near future. I would speculate closing out this year, early next year, middle of next year, we're going to see more talks of people being pushed out of homes and home buyers having to reduce the price of their homes to get those homes sold. All right. That's just what I'm suspecting. Doesn't mean it's going to happen. It's just something I'm suspecting. Okay. Next article, Apple is borrowing money to buy back stock. What that may say about the bond market. Apple is gearing up for a 4-part bond sale to fund stock buybacks. The Apple ticker AAPL is planning to use the proceeds from the sale for general corporate purposes, including buying back shares and paying dividends, the company said in a filing with the Securities and Exchange Commission. Apple didn't disclose how much money it was raising or what interest rates it will pay, but the latest report from Bloomberg said the offering was for $5.5 billion. So shareholders look for some dividends coming your way, and the question is, what's really going on with Apple that they feel they need to do this? Next article, analysis, U.S. banks face $1 trillion reverse repo headache. Oh my God, what's happening here? New York, Reuters, the trillions of dollars in overnight cash tucked away daily at the Federal Reserve could turn into a major headache for banks that could squeeze their balance sheets and impair their ability to lend. Wait a minute, what? This money that's tucked away could turn into a major headache for banks. It could squeeze their balance sheets and impair their ability to lend. Okay? They owe that Federal Reserve, don't they? The Fed is paying a record reverse repo rate of 2.3% following its 75 basis point interest rate hike last week. Barclays expects daily reverse repo levels to hit between 2.8 trillion and 3 trillion by the end of the year. Investors are effectively taking deposits away from banks and putting them into government money market funds. And we heard Gary Gensler talking about this a couple months back. He was saying, take your money out of the banks pretty much and come invest in these bonds, these secure bonds that the federal government has. And I have many thoughts on this, but we'll continue the article. All right, so it says, which invest mainly in treasuries and repos. So, hey, look, investors, bring your money over here to the Fed, get these treasury bonds and these repo bonds or these contract bonds, right? These secured bonds. These money funds, in turn, funnel the cash to the Fed's overnight window. So when the investors come in and start investing in these treasuries and these bonds that the Fed has, that money, though, that quote unquote, those dollars come back to the Fed and it bulks them up. So it says repo allocations from government money market funds have increased to nearly 40% of their assets currently, from around 30% at the start of the year, Barclays said. So the government is trying to allocate or move around these repos, these contracts, and they're trying to get money to essentially. So I'm gonna share my thoughts on this. This is what I think actually happened. So the Fed was coming in and buying up contracts or bonds from banks, making the banks liquid. Nothing is free. The Fed is not just giving banks money like, oh, hey, here, Bank of America, take X amount of billions of dollars so that you can continue to give loans to citizens, right? I don't think that was happening at all. That makes no sense. What clearly was happening was that the Fed would go to these banks. The banks would bundle up a whole bunch of contracts or debt bonds, debt loans, debt contracts. They bundle them up, and then they would essentially sell them to the Fed, or not so much sell them. They will put a contract in. They'll take a loan, right, from the Fed. Okay, so look, we're going to borrow, I don't know, $500 million from the Fed. We're going to give you these bonds as what's the term I'm looking for? As what's the term? You know, when you use your land as a lien, right, to get the loan to build your home. So you know what they initially, and my thoughts of how this is working is, they put up the debt contracts that belong to me and you, right? We've got loans with these banks. They put up those debts in a contract. They bundle it up for, let's say, the equivalent of the $500 million that they're going to borrow from the Fed. Then they have a mature date, which means there's a time when they have to then pay these contracts back, right? So it's not that the Fed gave them anything. It said, okay, well, you're going to sign this contract and this is what's going to happen. This is how I understand it. I could be wrong, but I'm sharing my thoughts and ideas on this and how I feel this all played out. So now you've got the bank that had X amount of years to pay back this contract, right? This contract that was made. So now that the contract's made, the loans are turned over to the Fed as a new bond contract. The banks are now made liquid. So then, boom, we have this rush of where they're giving out loans. People are buying houses left and right because the bank has liquidity to pay for these loans. So they say, you want to buy that house over there? Everybody's coming in to buy homes. Boom, boom, boom. The first thing we saw was cars. Everybody's buying cars. Then boom, boom, boom. Everybody's buying houses. Like, oh my God, where's everybody getting this money from? So the banks were able to do that. Now, after X amount of years, they've got to pay those bonds back, those contracts. So I personally think that they're in a situation where they're not able to pay those contracts, which puts the Fed in a place where, okay, well, we're stuck with these contracts. So first off, if that bank fails to do what it's supposed to do, we have the right to do what we have to do, which I assume is liquidate, freeze and liquidate. Then in the same breath, the Fed has to get payment for what it bought, right, in a sense, when they did the contract with the banks. So then they say, okay, investors, don't invest with the banks anymore. Come invest with us, the Fed. We've got all these debt bonds that have to be matured, right? So while these people are out there paying their debts, we have that bond, so that money comes to us. So you as an investor, don't invest with the bank anymore. We have the bonds. So now that puts the bank in a situation where they can be frozen and liquidated. That puts the Fed in a situation where they now are going to receive the finance. You see what I'm saying? And I could be wrong. But I'm speculating based on how I understand the matter. All right. And so here's some information. So what is a reverse repurchase agreement? It's conducted by the desk, also called a reverse repo or RRP. It is a transaction in which the desk sells a security to an eligible counterparty with an agreement to repurchase that same security at a specified price at a specific time in the future. So, hey, look, man, here's a debt contract. I bundled them up. I'm going to sell them to you, and we're going to set a date when this thing will mature, and you have to pay this debt back off, and then I return to you those contracts. That's how I understand it. I could be wrong, but that's how I understand it. So I just want to share my thoughts on that. Other than that, I am so glad you all stuck with me to the end of this video, because I just wanted to share all this information, and I've got more to do and more to share with you all. It's just, I got so many things going on. It's hard to get back to this, and I'm going to do my best to keep getting back to you all and get these episodes out, because I want you all to be informed and make these decisions for your future. So with that being said, I'm going to go ahead and stop here and say goodbye to you all, and thank you again for joining us. And I hope you return for another episode. And until then, I'll see you all later.